Hello, good morning, and welcome to Stonehearth Capital Management's quarterly webinar series, CIO's Corner for Q1 of 2026, featuring our Chief Investment Officer, Chris Scott here. My name is Ben, and I'm Associate Advisor at Stonehearth, and have the pleasure of working with Chris today. Before we dive into today's discussion, I do just have a quick few notes here. First note is to please use the Q&A button at the bottom of your Zoom window to submit any questions throughout the webinar. We will aim to answer as many questions during the Q&A portion at the end. Second is, if we run short on time and are unable to answer all questions, either Chris or myself will follow up with you directly to ensure your questions are answered. I'm now excited to introduce to you Chris Gothier, Stonehearth's Chief Investment Officer, who has over 25 years of experience in investment management. He leads our firm's investment policy and strategy, focusing on asset allocation, research, risk management, and portfolio management. Chris, thanks for being here. I'll hand it back over to you.
Thank you, Ben, and for that great introduction. And thank you, everyone, for joining us today. Broadcasting here from a wet, overcast day in New England. I guess spring just jumped out there for a second and went right back in. So hopefully we'll see it again over the weekend. But again, like I said, thank you, everyone, for joining today. We really want to talk to you, walk you through what we're seeing in the markets, right? How the economy is evolving, reacting to the current geopolitical chaos. I'm sure we all heard about the Iran headlines. We'll go through that a little bit, how that's flowing through to the economy. But given where we are in the economy, we may be all right and be able to weather the storm if it doesn't last too long. Then finally, we'll kind of close up with how we're positioning portfolios as we're seeing these risks rise in the marketplace. And really, the title says it all. We're navigating rising risks, but from a position of strength. Data is cooling, but the foundation of the economy and our portfolios really do remain on solid foundation. So with that in mind, let's look at the data, and as always, find a signal through the noise. So what we're looking at here is we're going to start with performance, Q1 2026. For those of you who have joined us before, you know we color code these. So anything you look at and see blue, think US equity. Anything in green, that's international, either EM or developed. Anything in purple, which is tough to see here because returns is just right around neutral for the quarter. They're in purple. We'll see it more when we look at the 1 year numbers. And anything else is in yellow. Anything that doesn't fit in those categories. And right away you can see the impact from the Iran conflict, right? It immediately jumps out with oil up almost 84% in the quarter. And that's really impacting commodities as well. The second best performer, 28, there's a big chunk of oil in there. And then followed by gold. And, it's interesting. Even the March weakness, gold was off almost 10% in the month, didn't derail the longer term outperformance we're seeing as investors benefited from holding the yellow metal. In fact, investors were rewarded in the quarter for holding anything, really, other than the mega cap AI driven US tech, which is all the way over there to the right. You can see that with the NASDAQ down almost 6% in the quarter and the S&P a little over 4%. So again, we really saw this major rotation, basically mostly in January and February before the Iran conflict, of people getting out of the tech-heavy concentrated portfolios and moving into other parts of the market, which really benefited not only other asset classes, but also our portfolios. And this shows the power of active risk management and portfolio construction, as we actually posted some positive returns in the quarter for our portfolios. Moving on to a longer time frame. We can see it over the past year. It's very similar in terms of the ranking. It's just the performance is a lot better over a longer time frame. But we're still seeing over the past 12 months, assets like emerging markets up 33% over the past year. International developed over 30, really posting much better returns than we're seeing in the US, which is down more in the 20s. See oil again leading the way, no surprise, right? If it's up 80% in a quarter, you're pretty sure it's going to lead for the year. But you see gold up 50% over the past year, still leads the way with the most consistent performance, right? It wasn't relying on one outlier month to generate that performance. It's consistently outperformed other asset classes over the past 12 months. Fixed income in purple, like I said, we couldn't see it on the last chart because it was so middling returns. But you're seeing, as we'll see further on in the presentation, it's doing what it does best, right? Just sit there and clip, get the coupon, and posting some pretty decent positive returns. So we're kind of taking it all together, Q1 2026 and then the last 12 years, the last 12 months. Headline, short-term volatility in the US, really not impactful enough to change long-term positive performance, right? Especially in markets outside the US. And it's good to remember it's a big, big world out there, bigger than just the US. And we need to take advantage of those opportunities when they arise. So that's what happened. Let's kind of take a look where we are and where we may be going. And again, given everything that's going on in the world, we're going to start with Iran-US conflict. And I find it interesting, right? When you think about this, why is this conflict, right, in a small, narrow waterway halfway across the world having such a large impact on the global economy? Well, it's just the amount of oil that goes through it. And we're looking at this chart from our friends at the Financial Times, right? In the middle, you can see that's like 15 million barrels per day. So for frame of reference, that's almost a quarter of the oil that's shipped anywhere in the world in any given day goes through this tiny little strait. You see the countries on the left that ship the most. Saudi Arabia up at 6, UAE 2. And again, you see Iran down there at 1.3. And on the right-hand side, you see the beneficiaries of all this oil that gets shipped, right? And number one stands out China. But you also have India, Japan. So we would expect, and we did see this in asset class performance, at least in the month of March, that those countries may be impacted a little bit more because they get more of their oil from there. So we saw Asia get hit a little bit hard compared to that. So again, with so much oil going through there, and Iran essentially closed it, and then we came in with a blockade. Although I looked at the news today, and we may be lifting the blockade, but this is as of the blockade, and we can see that it really did dampen everything. Nothing is moving through here. So what we're looking at the daily ships passing through the strait, right? You can see that it was up at 40 or 50 ships per day back in February, down to pretty much zero, right? There's almost nil. There's no oil getting through this little strait. And this was actually numbers, if you looked, April 2nd, before we implemented the blockade. So not really a good place for the US and global economy. But a good thing for financial markets is that we've been here before, right? We've seen this throughout history. We know what happens, right? So we're looking at 18 events of military conflict since 1926, right? And what the impact to the U.S. market, see 3-month returns, 1-year returns, 3-year returns. Some of us have probably been alive during these, the Iran-Iraq War, invasion of Panama. We saw the Russia invades Ukraine, just to name a few. But taking it all together, right, looking at totality, the history shows like military conflicts tend to have a very limited impact to long-term performance, right? We're just talking about financial assets. Short-term volatility tends to give way to underlying fundamentals, and the majority of the time showing a very strong recovery a year out. So again, and even stepping back and taking a bigger picture, we can see that impact if you look at long-term price returns of $1 invested in U.S. stocks. You can see that in the great scheme of things, it's just a minor speed bump on the road for financial markets. We're not dismissing the human toll wars take on civilizations. But again, from financial markets, it tends to look through it pretty much and move on forward, depending how the economic data is playing out at that given time. And as we're going to see going forward, we're pretty strong economics. But like we said, what is the main transmission mechanism from this conflict over to financial markets? Simply, it's oil, the price of oil. We're a global economy run on petrol, right? Oil goes into almost everything we do. So it's kind of the engine that starts the economy. We'll look at a chart of Brent crude oil prices, which is European oil. Then we're also looking in purple, WTI, which is US oil. And they pretty much trade the same, a little discount here and there. But again, you can see that the impact of the conflict beginning in March with oil up 36% as of April 13th, right? So we're still up 36% despite being off the highs. And when we look today, I know there was some relief based on news headlines. I think the oil is right around 81, 82. That's still 20% higher than it was when we started this conflict. So that has to have it has to have an impact on the economy with oil being that much higher than before the conflict started. And the million-dollar question, right, is the duration of the impact. How long does oil stay up at these elevated levels? Does it stay elevated compared to where it was before the war started? And the way I like to think about this and talking to clients, so if you think about a tree, right, maybe in your backyard, you want to chop it down and you start to try it and you're hitting it and you're hitting it and you're hitting it, it just won't break, right? It's a very strong, strong base, just like the economy. But like everything, given enough time and consistency, and you keep working at it and keep hitting it and keep hitting it and keep hitting it, it will break eventually. So again, that's when we talk about duration is the really key factor to see what's going to be happening with the economy going forward from here a year out. So luckily, as we'll see in the next few slides, the economy really is operating from a very strong position. And what we're looking at now is the GDP Now calculation model from the Atlanta Fed. So again, you're all familiar with GDP, gets reported by the government, usually with 3 to 4 month lags, and then revise it and then revise it. So it's a great number. It's the best number we have to understand what's going on, how much the economy grew, but it's really backward looking. It tells us a lot about what happened. What I like about this is that it is a model, but it's taking real-time data as they're issued by the government, putting it into the model and calculating based on all the current information what they would expect GDP to be. And you can see in the beginning of March, they had it up at like almost 3% growth. So again, very strong coming into this conflict. And you can see the impact of those higher oil prices in the numbers that it has come down, but it's still pretty good above one, right? So again, 1% growth, not great, but growth nonetheless, not a recession. So again, we're such a strong position that we're able to kind of hopefully sustain economic growth if this doesn't last too long. And we're seeing growth slowing for sure. But again, not enough to tip us into a recession. The other way you're going to see the impact from the oil prices into the economy, again, is inflation, right? Again, we've been talking about this before the war started. Inflation was too high, and it's still too high. And we're looking at numbers here, and the consumer price index, which is as of March 31st. So again, it takes into account that oil price rise that we saw in the previous chart due to the war. And you can see it's definitely headed in the wrong direction, right? Up at 3.3, which is the top chart right here. Again, far above two and headed in the wrong direction. And even if you take out energy and also food, which is what they call core, the Fed likes to look at that number because they think it tends to be less volatile. That's that blue line here. And you can see as of March 31st, it's 2.6 and really not rising much, right? Again, oil hasn't flown through yet and it's not included in that number, but still way above two. So even excluding oil, still too high and not headed in the right direction, right? We want to get to two, and anybody, even if you don't know technical analysis, you don't know how to study charts, just look at the line, right? It hasn't gone down any meaningfully anywhere for a long time here. And it's not headed down, it's kind of flatlining here. So we really need to get that down. Then we look at the purple line, which is the producer price index, just another way to measure prices. It's the beginning of the production cycle. This is more what companies pay rather than consumers. So it kind of bleeds into the consumer price index. And that's definitely way too high, almost up at 4%, and definitely headed in the wrong direction. So not a good sign on the inflation in front. Again, this could all be nullified if the war ends, prices come down, we could see a change, but we're not going to get us down to that 2%, which is still too high. And then lastly, looking at that bottom green line, the expected change in inflation rates, that's inflation expectations based on survey data and what the consumer thinks. And that dichotomy we're seeing, you can see it actually is kind of falling. So it kind of gets troubling. We have oil prices rising, but inflation expected change falling. That dichotomy explains a lot of the price action we're seeing in April with markets rising on every headline. Things are getting worse in the data. We see that, right? But consumers, investors are more optimistic about a resolution. So they're thinking about the duration and thinking that it's not going to be too long before we see a resolution and return back to the status quo. So also, we're looking at PMI surveys. Again, we've talked about this before. The red line is consumer, right? So that's that service line. Think consumer, manufacturing in the green line. These are diffusion indices as of March 31st. So again, they account for the war, and they're kind of looking at what's happening, right? What's going to happen. They're asking companies multiple data points. Are things getting better, staying the same, getting worse? Add it all together. 50 above, economic expansion. And just like we're seeing in the data we've shown so far, we definitely see an impact from the war, especially in that services, right? Down from 56 to 54. But since it's such strong coming into it, it can withstand that hit. And 54 is still very high above the 50 line and showing expansion. And we look at the big jump up in manufacturing, and even though it's flatlining in March, you still see it's safely above that 50 line. So again, taken together, they're indicating the path of least resistance for future economic activity is expansion. Also coming into this conflict strong was the consumer. And this is the consumer in aggregate, not any one person, not any one state. We're taking over 300 million different people out there and kind of coming up with an aggregate number. And then you look, they were pretty good shape coming into the conflict, right? Strong balance sheet on the left, you can see that. Look at the bottom right hand, look at these are delinquencies. Look to be rising, but still very manageable levels compared to history, except for the big orange line, which is student loans, which we talked about. But I did want to talk about these numbers a little bit here, these delinquencies. They're getting skewed a little bit from the COVID. So we look at these, the green line and the blue line, look at the levels. You can see back in 08, and unfortunately we all on the call remember that. You can see that really got above 10, 12%. That was the consumer was in crisis, right? The consumer couldn't spend, then it came down. But we look throughout history, other than this COVID dip, under 10% is still a pretty healthy delinquency rate, right? Some people are always going to be delinquent on the payments. It's just the fact of the economy run on debt. But these levels are not at that extreme level where we say the consumer's in distress yet. Definitely heading upwards, but more flatlining, but not in distress yet. And the most important, especially to us, that top right is that, unfortunately, the economy runs on debt. And as long as consumers can make their debt payments, and that's what we're looking up here on the right-hand chart, right? This is the amount of debt payments you're making as a percent of your disposable personal income. So how much you have left over after taxes, how much is going towards your debt payment, not you individually, but the consumer as a whole. And you can see at 11.3, definitely probably too high than it should be. But compared to history, you can see when people get stressed, when we start seeing problems like fourth quarter '07, you're at 16%. Back in 80, it was at 12.4%. So again, definitely too high for a comfort, but still enough that you can still see consumer spending. And unfortunately, if people can pay their bills, they're going to keep on spending money. Spending money increases the economy. So again, given the position of strength, they should be able to weather the storm if the duration doesn't go on too long. Also, what's kind of not being reported in the press too much is still we have the benefit of the OBBBA, the one big beautiful bill coming in. So again, this is going to be offset by the gas price drag. We talked about the price of oil that has to affect your bottom line. And as a consumer, you see that in the average gas price. That's the first way you're going to see that effect. If you think that the average gas price in April was $4.13. In the February, it was just under 3. And if you go back to last April, it was only at 3.19. So we definitely see a negative impact to consumer spending on that. And we can see that right here, right? This is this brown, so it's negatively impacting the consumer. But higher gas prices appear only to partially offset the stimulative impact of the larger refunds that we talked about last quarter too, that we're getting from the OBB, and that's that blue line. And the blue dot is actually the net number. So even with the higher gas prices, you still see consumers are in a better spot than they were last year. Definitely always affects the upper income more, right? They're faring the best with this, but with this cohort responsible for an outsized share of spending, the energy price shock, if resolved in the short term alone, should not topple the U.S. economy into a recession. Also, don't have a chart on this, but think about the midterm elections. They may be troubling for the Republicans. How can they help themselves? They can have more stimulus coming into the economy. So again, hopefully there's a lot of offsets to the negatives out there. And lastly, for the consumer coming into this, they're in a position of strength. What's the employment picture? I know there's a bunch of headlines out there. You're seeing there's layoffs, but it really hasn't focused through yet because they're in such a strong position of strength. So look at the pink line up top, average hourly earnings. That's 3.5%. So again, with inflation running just under 3, we have hourly earnings growing at 3.5. That means people who are employed have more money in their pocket and they can spend more. And then the number of people employed is still pretty high compared to history. We look at the unemployment rate, it's only at 4.3. So again, that's almost near full employment. So you have more people throughout than we've seen in history employed, and you're also seeing earnings being outpacing inflation. That's a recipe for future economic growth, more money in their pocket, They spend more, increases economic activity since consumer makes up about 70% of the GDP in the US. So again, they have a nice tailwind there. And then lastly, that blue line, the US non-farm payrolls, very volatile since 2025, hovering right around that zero line, but a big uptick in the last number reported. So again, we're still creating jobs. And then yesterday they had the unemployment claims came in at a record low. So again, an employment market maybe not going gangbusters, but definitely strong in helping the consumer. So also helping the economy is the Mag 7. So the CapEx hyperscalers. You know them as Alphabet, Amazon, Meta, Microsoft, Oracle, and they're helping the economy a little bit more than themselves. You can see in the right-hand line, they're spending a lot of cash to do this. They may not get that return on investment, but they continue to pour money into the AI ecostructure. And you can see in the chart on the left, no signs of slowing and actually increasing. So last time we met, 2025 was an estimate because we didn't have all the numbers in yet, and we're there at $400 billion. Yes, beef, that's 400 billion moving into the economy. That actually came in at 416. When we look at 2026, last time we met, we're at 533 billion estimate. That's up over 100 billion to 677. 2027, the same story. We're at just over 600. Now we're firmly above 700 for 2027 estimates in investments. That money does get invested. That goes into building data centers, buying chips. All that is economic activity, moving money through the system, creating economic activity that helps economic growth. So again, it may not help those people who are investing, because they may not get a return on their investment, but it's definitely helping the economy grow and helping them support what we're seeing as decent economic growth out there. And then finally, closing out the economic landscape, the world economies are also in a good spot. So looking at PMIs again, looking at it through different lenses, the developed market, EM, in different countries. You can see as of February, which is this column right here, coming into the conflict, they're in a really good spot, right? You don't see a lot of recessions there. In fact, none. France was the only one that was a little bit under 50. Our friends over in France. We don't have all the data for March again because they report at different levels, but you see the ones we do that, yes, just like all the other economic data we're seeing in the US, they're seeing an impact. But again, given how strong they were coming into this conflict, you can see that they're able to weather the storm as long as the duration is not that long. So the world is in a pretty good place. So thinking about the economic backdrop, yes, we're seeing negative impacts across the economy from the Iran conflict, but the economy was in a very strong position entering the conflict and should be able to withstand that short-term shocks as long as we see a resolution. If we're here next quarter still talking about the Strait, we're going to be having a much different conversation. But as long as we're not doing that, the economy should be able to weather the short-term disruption that we're seeing in the marketplace right now. So that's the economy. So we're going to turn to fixed income here for a little bit. Talk about the bond market, the boring old bond market. But they're boring, but that's the goodness of the bonds, right? They are boring. They can still play an important role in the portfolio. They dampen volatility. And given the current yields we're seeing, they remain attractive ballast in a well-diversified portfolio. So looking at different stages of the bond market, U.S. Treasuries, asset-backed securities, which is like credit cards, commercial-backed securities, which is commercial mortgage lending. But overall, it goes from less risky to more risky. And you can see those numbers there. Those are the rates, right? The yield they're paying. So how much income you get on a yearly basis. And just taking corporates, you can see that for the past 15 years, they've been in a range from 6.5 down to below 2, and that averages 3.4 over that time frame. And where we're at now, we're at 5.1. And we look at all the other ones, we're safely above the averages. So rates have risen, but that provides an opportunity with fixed income to get a higher yield and to collect more income. So again, boring is good in fixed income world. I don't want a lot of excitement. I just want to sit there and collect my 4% and help with portfolio volatility. So it's very attractive right now, given what we've seen in the level of rates compared to what we've seen over the past 15 years. Then if we turn to the corporate world, we're looking at spreads. So when we think about spreads, what we're looking at here is the amount over treasuries that banks are charging to corporations. So anytime they do a loan, even your credit card, everything starts with that risk-free rate. That's a U.S. Treasury. and then it adds on risk depending on the individual borrower's needs, right? So again, what we're looking at here with the blue line is the high yield index. So again, you would think that if a higher yield corporation, which is a more risky corporation, you have a little bit higher income because there's more risk there. And the green is a corporate. So we're looking compared to history that that is very, very tight, right? That they're being impacted. You see the small uptick from the turbulence, and also from the turbulence seen in the private credit space, but not enough as the canary in the coal mine saying something's wrong yet. Again, compared to history, we look at the chart on the right, very contained, very calm. This is good for the markets. As the banks are lending to corporations, they're not seeing any major risks out there yet. So again, another good sign for economic activity moving forward. So now we'll turn to the equity market, and we'll start with the technical picture. We'll start with the S&P 500. Again, this is as of April 14th, so you can see it does capture the big dip from the start of the conflict, but it also captures a lot of the rebound, not what we're seeing today, but as of April 14th. So it represents the initial sell-off and the current rebound. And just like the economy and everything else we're seeing, the technical picture was in good enough shape. So the event we are seeing some weakness, the overall picture is not gloom and doom because we're so strong coming into it. We have upward rising moving averages. We always know that more stocks going up than going down is good. And we can see those moving averages over time going up. We can see this bounce off the 50-week moving average. And again, there's an old investment axiom. Nothing good happens below the 50-day or the 200-day moving average. And we can see that once it got down there, it bounced right back up, which is a good sign of a healthy market. See RSI, again, not giving the all clear, but not showing any major signs of stress. MACD, which is a short-term momentum indicator, you can see that's actually turning up, that yes, it did turn down, but it's kind of coming back. So when we look at the technical picture, where do we stand now? Not as good as we were in March, or actually in February as a start of the year, but okay. And for now, okay is good enough. Another good sign of a healthy market is breadth. And when we look at the breadth of the current market, looking at the global stocks, we can see a nice rebound. Definitely see the sell-off from the conflict in Iran that began in March, but we see a nice rebound and again, healthily above 50. And more importantly, just like we saw in the moving average of the S&P 500 price, 200-day moving average of the breadth bounce right off that 50 mark, a little bit below. So again, good, strong breadth, nice bounce. And again, we know markets are strongest when broad, and we're seeing strength across the globe in equities as of right now. Oh, sorry, just a little technical difficulties there in moving my charts. And now we'll take a look at investor sentiment. Again, we're looking at the S&P 500 index up top, but below we're looking at this crowd sentiment poll. This is what we call a contra indicator. So again, what's it mean? It means when we get to the extreme optimism, when we get high, that's bearish. Well, why? Just think about the logic, right? If everybody's optimistic, who's left to buy more? Same thing on the downside. If everybody's pessimistic, if everybody thinks the market's going down, there's no one left to sell, and you queue for a reversal. So that's what we're looking at here for, those reversal points. So again, we can see the big sell-off of optimism down to a better level below 55 due to the war. Right. So again, not a complete washout, and that's something to keep an eye on. So what we like to see in terms of from an indicator is that you get down to these 30s and 40s, then you see a big, nice rebound. We didn't quite get there. Maybe it's a good thing. No one says we have to go back down there, but it's something to keep an eye on that we may get a retest of those lows. But for now, again, since we haven't seen those lows, it leans a little bit bearish now, but again, improving. So again, mixed picture, but sentiment is on its way up. What's really also helping equities is the fundamentals. We talk about this a lot. Earnings drive stock prices. And what we're looking at here is on the left-hand side, growth estimates for the first quarter 2026. Well, actually for the year 2026. And you can see that compared to 3 months ago to the current's in blue, 3 months ago is aqua green, and this is as of March 31st, so it includes impacts from the Iran conflict. The majority of the world, growth estimates have risen, and especially high in the US and the emerging markets, and you can see that here on the right-hand side. The most important thing for earnings is the estimates, right? It's not the level, it's the estimates. Are we beating expectations? We know the equity market prices what's going to happen, not what has happened. So it's look forward, right? So it's looking forward to earnings, expecting a certain amount. And when this green line goes up like that, what it's saying is that given everything we know as of March 31st, which includes the Iran conflict, we think earnings are going to be stronger than we thought before. So again, rising earning expectations, good for equity prices. And you can see compared to history that usually as earnings season comes around, we start lowering our earnings estimates. Analysts are actually rising this time. So again, another good sign for the equity market on the earnings estimates that they are rising. So again, pretty good fundamentals heading into this, and it should be able to weather the storm. So that really is the equity market. And now we kind of want to take a step back and take a big picture, right? So we looked at all the data from the economy, we looked at the fixed income market, we looked at the equity market, but how does this affect portfolios? How do we implement what we just saw? How do we kind of take all that information and find the signal to the noise? Well, if you have joined us before, we use risk models, right? And we use two main risk models. And the first one we use is from our friends at Ned Davis called the Fab Five. 30 different indicators broken down to four categories. And it did. It moved into bearish territory in the quarter. Right? We saw monetary conditions, which is down here. I think that's the cost of money, right? Higher rates, less money sloshing around. That bearish. We also saw sentiment negative. Again, we saw it come down, but not to levels that had get us too excited yet. We saw the tape as neutral. And we saw that when we looked at the chart too, that yes, it's still good, but not as good as it was. So keep that neutral. And combo is anything else, international and other models. So bouncing around neutral. So we need to really see this model move above 1.5 before getting too excited to add back into risk. And at 2, it's just saying that the risk environment has increased. Risk is not as appealing, doesn't give you a higher risk reward than it has in the past. And that's not the only model we used. We do know Ned Davis has some holes that we wanted to complement with our own internal model. So we created our own SEM risk model. It's confirming the signal we saw from Ned Davis, right? Conditions have worsened, and we're at a -1 now. When last time we spoke, we're at neutral, but not falling off a cliff, right? So the drop in tech it was enough to offset the strength in macro. So we saw the big macro jump at 3, but we saw a technical structuring reversion that was at +3 last time we met. Now it's down to a -1. So that's where we saw the weakness in the model. So this model is meant to be additive, not duplicative. So again, they can disagree, but when they're aligned, it definitely gets our investment committee's attention to ensure client portfolios are aligned with the signal. So taken together, the slight decline in both models was enough of a signal to slightly reduce risk in client portfolios, which we did in the quarter near the end. So let's take a look at how all this translates into the portfolio. So last time we met, we were overweight equities. You can see we moved to neutral there. Still underweight the US. Again, concern about the Mag 7, the concentration. We're still finding opportunities in the value stocks and some momentum stocks. But again, not excited enough to go overweight that. International developed is kind of where we moved. We moved a small piece of that portfolio out into a less volatile market neutral income producing product. So that moved to neutral international developed. Still like emerging markets the best in equity land, and we're overweight that particular asset class. Again, just better valuation, better momentum, better fundamentals moving forward as we move forward. Fixed income, still overweight. We talked about it, just like those yields that are higher than we've seen over the past 15 years. Happy to sit and collect the 4 and 5% for a piece of the portfolio and help dampen portfolio volatility. And we moved to neutral for cash defensive hedge. That's kind of a catch-all bucket. So that holds our relative strength strategy. So that has Latin American stocks. It has commodities in there, has some gold. So again, and also the market neutral product we hit. So again, neutral. Not too defensive, but not overly bullish either to get to that neutral valuation. So again, closing up before I give you some key takeaways here. The portfolio is aligned to what we're seeing in the risk modeling. It's not as attractive risk environment as it was at the end of 2025, but we don't see any really huge detrimental hit to the economy yet, as long as we get a resolution and the duration is not that long with the Iran conflict. We're in a good position coming into it, and hopefully we'll be in an all right position coming out of it. So a few key takeaways before I turn it back over to Ben for questions. We saw the history. We've seen it throughout. political shocks, short-term volatility, yes. But again, if you're coming from a position of strength, you don't see a trend reversal. And the same if you're coming in a position of weakness, you don't see a trend reversal from that either. So again, as long as duration is manageable, we should see good performance moving out. Like I said, economy, very strong coming into this, should be able to absorb any short-term shocks. Fixed income, still a viable portfolio addition given the high levels of yield we're seeing compared to the past 15 years. Equity market, right? Structure remains stretch, but the fundamentals, think about the earnings, technical backdrop is still supportive. It may not be showing robust growth, but it's still supportive of equity prices and provides some downside protection. And then lastly, putting it all together into that one liner, like the signal from the data is a slight reduction in portfolio risk due to deterioration in the global risk environment, but we're not seeing much more than that right now, given the data we're seeing in the marketplace. So I want to thank you all for going through. I know it's a lot of data there to go through. And for that, I want to turn it back over to Ben to see if clients have any questions out there.
Awesome. Thank you, Chris. That was fantastic. We do have a couple here in the chamber. First question here is, do you invest in the private credit funds that are having all the problems right now?
Yeah, they're definitely making headlines with all the redemption requests we're seeing out there in retail world. Yeah, thank you for that question. I'd be remiss if I didn't say that we did write a piece on this, so thank you for asking the question. We put it up on our website blog, so if you want to go out there and check it out, that'll give you a lot more detail on the answer. But for me, the cliff notes to that question, right? You know, it's just a different asset class today compared to history, right? We had too much money blindly poured into it, really without an understanding of the structure of it, right? There's a liquidity mismatch. Investors, it is in the fine print, like how many people read the credit card fine print, and I'm sure some advisor told them very quickly that it's kind of illiquid, but you can get your money out. Well, we know these should be illiquid products, right? If you're lending to these companies for 5, 10, 15 years, you shouldn't be able to provide monthly, quarterly liquidity. And we're finding that's a problem now. And it wasn't well understood in the marketplace. With the money coming in, you have looser underwriting standards, right? So again, the borrower has more power than the lender. Good for the borrower, not really great if you're investing in the lender, which is what you're doing when you're lending them money. You want to have the greater power, right? Because you want to have the better terms. So the greater power by the borrowers is also a concern, right? So you put all those together and that much money flowing into the asset class, it's just never good for an asset class. And again, we just feel investors are no longer being fairly compensated for the amount of risk they're taking on. So long way of saying, no, we don't currently have any direct exposure to private credit. But we are still finding opportunities in the private space, just more on the equity side. So if you have any interest in the private equity, please don't hesitate to follow up with us after the call to discuss. We're happy to go through some of the opportunities we're seeing in that spot. But there will be a time to invest in private credit. It's just not right now.
Good. All right. Very good. Second question here is, what should I be worried about now? Too much risk or not enough risk?
Good question. Yeah, I like that. So again, just kind of paraphrasing, we should be positioned with all the concerns out there. And yeah, you're right. A lot of concerns out there, right? In addition to the private credit we just spoke about, geopolitical, that's a no-brainer. We know that's out there, but we also saw too high inflation. We saw rising rates, public debt, political polarization. So there's a lot of risk out there, but I mean, the biggest concern, like with financial markets, to me, really, really the fragility of the market that has been led by a very small group of stocks over the long term here, right? Investors having too much exposure to a really narrow set of winners. They always say history rhymes, but it doesn't always repeat, right? So the winning trade of yesterday can quickly become a liability. And we saw this in the beginning of the year, February in January, before Iran and the oil took center stage. We saw that rotation out of those names. And we saw that in the first quarter performance in the S&P 500 and the NASDAQ. The challenge for most investors, right, really in finding that right balance, avoiding being caught off guard by volatility, but not being so protected that you miss out on growth. And really, that's the essence of what I try to come in and work on every single day on client portfolios. And what we've come up with is a framework that helps address this, right? So this should help answer your question. We address this through multiple layers. We combine global diversification, right? It's a big, big world out there. You don't need to be just investing in the S&P. You can go over to get some exposure to France, Latin American stocks, China stocks. So global diversification with an active risk management based on data-driven historical context risk modeling. That's our risk modeling we see. When we see risk becoming too expensive, we may pull back a little bit. When risk becomes cheap, adding to that. So moving around that risk curve a little bit based on the current data that really filter out market noise and we find that signal. And most importantly, for you, for your money, we focus on customization, right? It's your money. We align your portfolio with your individual constraints and temperament, allowing us to proactively position your portfolio on that risk curve that gives you the highest probability of achieving your unique financial goals and hopefully allowing you to sleep at night, which is ultimately the end goal for us is to make sure that you're successful with your financial goals and that you can sleep at night, hopefully. So a data disciplined investment strategy tailored to your needs keeps your portfolio on the right side of the ledger and really hopefully away from any self-induced pitfalls. So that hopefully answers your question.
That's awesome. Really good. Well, those seem to be the only two now. But as always, if you're listening to this both now or listening to the recording when we have it up in the next few days or so, please feel free to call or email the office. Chris and myself, we'd be happy to get back to you and answer any questions you may have. As of right now, this is it for Q1 of 2026. Thank you, Chris, for your time here today. Thank you to all of our listeners as well who have joined us for this webinar. Please join us for Q2 as we'll do that in the next few months. All right. Thank you all.